Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts.
This is kind of a little flow chart or a little outline I think that you can use in the way to go about these things. As I said, first we kind of look at kind of a global macro view and try to make this distinction first of just pure money flow. What regions of the world, what asset classes are hot? And within this, ultimately, we try and find out the ultimate goal of all this fundamental analysis in terms of the detailed drivers of a currency comes back to interest rates and economic growth. These ultimately are the two biggest drivers of currencies that we can always hang our hat on that are solid. We can talk about deficits. We can talk about federal budget deficits, current account deficits, oil production. We can talk about all this stuff. And lately, a lot of this stuff has been highly correlated. But over the years, the things that have really held the test of time in terms of currency analysis are these two things. And you always want to keep these in mind as you're doing your fundamentals. What are the interest rate differentials between the major currencies? What's the economic growth differentials between those competing currencies? Because if the economic growth looks the same in two currencies, but yet one is a high yield and one is a low yield, the higher yield currency, again, everything else being equal, it never is, but we're assuming that to make this distinction. The currency with the highest yield is going to tend to pull in more global money flow, global capital flow. Global capital flow is the driver, thus, of prices. Currency money flow really comes in two forms. Number one, it's the hot money flow, driven by either fear, as the current account as the credit crunch proved, money ran into the U.S. market because of fear, not necessarily because of yield, or you have a hot money flow in normal times, normal economic times, is driven by yield. There's pools and pools of capital out there that flow in and out of economies in markets, in countries, in order to achieve the highest yield. And everything else, again, being equal, those currencies with the highest yield will win. But it's not always the case. Economic growth is also a powerful driver, even if yield may be low. They go hand in hand. Let me give you an example of what economic growth would be in a driver. It brings in foreign direct investment. It's that part of the money, those big portfolio flows that come into a country that have to buy a currency because they want to get involved in the country's assets. They want to be positioned into real asset classes or major portfolio investments in their stock markets or bond markets, that type of thing, that plan to be here for years as the terms of the hot money flow that can tend to flow in and out. That's, again, a powerful driver. So you think of currency capital flow as two major pools: the hot money flow driven by interest rate differentials, or the expectations of changes in these interest rate differentials. The expectations of the changes, again, which is part of your analysis of what the consensus thinks, those are as much a driver as not. Again, back to that point, you want to understand what the consensus thinks, and if they expect an interest rate change in a certain country and they don't get it, that shows that reality is different from the consensus. Therefore, it was a surprise. You can expect some price action. There's where just understanding what the consensus expects in your basic fundamental analysis can help you make money. Economic growth is really those capital investment opportunities. And this is one of the reasons people believe that ultimately, from a longer-term secular standpoint, we will see the Asian currencies and the Asian bloc obviously be dominant in the future. This is that long-term foreign direct investment. That there's, in terms of the world, when you think of the world, what's hot and what's not, where are the best long-term capital gains opportunities? There in Asia, with the growth of China, the growth of the whole Asian bloc, or at least that's the view now from a long-term secular standpoint. So that driver in the background, regardless of what goes on near term, is ultimately a powerful one that will tend over time to support the Asian currencies. again, this goes a lot to do with what's going to go on in China, whether or not we're going to see some type of pullback here on the unrest. That's neither here nor there at the moment. But in general, the capital gains opportunities have been offshore. So if the capital gains opportunities tend to be offshore, outside the U.S., in general, the pressure will be for the U.S. dollar to be lower over the longer term. That's a long-term macro view of the fundamentals that you can keep in mind. As I said, we develop alternative views. We kind of encapsulate, all these views in all of our reading each day. And we developed a most likely scenario for the dollar, and we always try and develop the dollar view first, because keep in mind, the dollar is still the big dog in the world. The dollar is the world reserve currencies. All the major currencies trade against the dollar. The dollar is what people have to have if they want to buy commodities. The dollar is what they have to have for major capital transfer across countries and regions. So the dollar is still the big dog and the driver, so that should be your first decision in terms of your analysis, developing the most likely scenario, which is what basically understanding what the consensus thinks, and then developing that probable scenario, that alternative scenario that you think that can play out. And if it starts to play out, you can switch positions fairly quickly because you're open. You can say, hey, I've already thought about this idea. It makes some sense. The fundamentals are starting to prove out my secondary view. Time to change positions. Where if you only had one view and something starts to play out, you're going to say to yourself, well, I think I'm right. I think the market's wrong. Well, I think I'm right. I think the market's, I think I'm right. And then you get into that spiral of getting hung up on your view. Creating these alternative views allows you to ditch your positions when the market proves you wrong and not stay and get stuck on a view. As I said, first we develop the dollar scenario, and I'll explain to you. And we'll go into the dollar scenario today. I won't have enough time really to get into too many market themes or scripts. Market themes and dollar scenarios somewhat tied together, obviously, in different time frames. But a major dollar view, market themes. For example, is it that you've probably heard the terms risk appetite or risk averse environment? Is it a hard asset environment, and we need people moving into commodities to hide from inflation? Therefore, the commodity currencies may do better than anything in the world. Is it a risk appetite environment, meaning people want to move offshore right now for those capital gains opportunities opening up in the emerging markets? That's a risk appetite environment. That's a powerful driver, and you're going to see the currencies move with it, obviously, along with the other asset classes that are going to tend to support it. In a risk-averse environment, that was the credit crunch environment. People were running to hide. Therefore, in a situation when the world in and of itself is very fearful of what's going on in the financial markets, the world reserve currency always tends to do well in that environment. And what is the world reserve currency? The U.S. dollar. So again, there's the thematic scenarios that are in play at all the time in the market, short-term, intermediate, and long-term. Obviously, you can start, as you get more sophisticated with this, you can see how you can start to bucket this stuff into time frames. Maybe something that you think, 2, 3, 1, 2 months, something 12 months, something, they're major themes, long-term drivers. You can actually start to break down your fundamental analysis, as you should, in the time frames that you trade. Again, I don't think doing fundamental analysis, if you're trading intraday, is something to hang your hat on, because there's so many random moves, especially in currencies intraday. But again, if you step back from months to years type of time frame, the fundamental analysis is very, very important. We actually develop currency scripts for each of the major currencies, and we have a view on a lot of the emerging market currencies here too. Currency scripts for example, let me give you an example of the euro. What's a fundamental driver for the euro in the background? We happen to think the Eurozone banking system is going to be a powerful driver for the euro one way or another in here in the next 3 to 6 months. We happen to think if we get a pullback in a double dip recession, so to speak, and a negative surprise on Europe, and I'll explain this in China, it's going to ripple into the emerging markets and really bring the exposure in the Eurozone banking system to the fore.
Thank you for listening to our podcast.